Okay, class, today we are going to review adjusting entries that we learned in Principles of Accounting. So this is for week one in Intermediate Accounting 1. In chapter 2, Learning Objectives, Learning Objective 2.5, we're going to revisit adjusting entries. So really quick, here's a slide, illustration 210, goes over the 4 types of adjusting entries we saw in Principles of Accounting. So prepayments account for 2 types and accruals. So prepayments, what this chart says is, here's an example of prepaid expenses. So when we adjust the prepaid expenses account, we are reducing the asset and we are creating an expense, right? So at the beginning of the period, we have just say 900. At the end of the period, we have 3. So 600 of that needs to be adjusted for or accounted for. And how this affects the financial statements, since we are increasing expense, we're basically going to decrease our net income, right? Because there's more expense, so we have less net income. We're also reducing our assets because we're crediting the asset. Deferred revenue. So deferred revenue is when you receive cash before you perform a service. That is an unearned revenue, current liability. So how we account for that when we adjust, we reduce liability by debiting it, right? So liabilities usually have a credit balance. So when we adjust, we debit, and the revenues we credit. So that's the good thing. We actually earn that revenue now since we provided a service or delivered the product. How does it affect the income statement or the financial statements in whole? We increase income because we have increased revenues now, and we reduce our liabilities. Accrued expenses, it could be salary expense, wages expense, utilities expense. We account for that, the adjusting entry, by debiting the expense, crediting the liabilities, and how it affects the financial statements. We are decreasing our net income, right, because we have more of an expense, and we are increasing our liabilities since, debit salary expense, credit salary payable, we are increasing that liability. Accruals, think of accounts receivable automatically, and think of revenue. So IOU, remember that. So if a customer pays, doesn't pay in cash, they pay in account, we debit the asset, credit the revenue. How that affects the income statement, it increases income and it also increases assets, right? Because we have that accounts receivable. So let's dig into a problem. Hopefully you guys can see this. Pastina Company sells various types of pasta to grocery chains on private label brands. The company's fiscal year end is December 31st, so it's a calendar year. So here's an unadjusted trial balance, and here are all the adjustments we need to account for. And it looks a lot bigger than it is. I think it's a portion of a problem where we make a worksheet. So basically what we're going to do is, as if there was an adjusting entry column here, we'd be making these adjusting entries. But I think in the actual problem itself, they just want to see the journal entries. So let's go through this really quick. Number 1, depreciation on the office equipment for the year is $10,000. So this is as of December 31st. So we don't have to calculate anything. They give us this number, which is good. So we're going to have a debit to depreciation expense, and we're going to have a corresponding credit for the same amount to accumulated depreciation. Remember, accumulated depreciation is it's just accumulation of every period, so to speak, when we allocate that cost, right? Because remember, depreciation is not market value. Depreciation, we're just allocating costs over a period of time. Number 2, employee salaries and wages are paid twice a month, on the 22nd for salaries and wages earned from the 1st to the 15th, and on the 7th of the following month for salaries from the 16th to the end of the month. So salaries and wages earned from December 16th through December 31st were $1,500. So let me see, this is number 3. So actually, I'm sorry, number 2. It's hard for me to even see this. So basically, in the prior slide, we spoke about salaries. We're going to debit an expense and credit a payable, right? So we're going to accrue, keyword accrue. This is opposite from cash basis accounting. Cash basis accounting, it's not GAAP compliant. So we're going to debit salaries and wages expense, $1,500, and credit salaries and wages payable. So we're going to hit the income statement. We're going to hit the balance sheet. And notice that each of these adjusting entries always affects the income statement and the balance sheet. And you won't see anything adjusting entry with cash, right? So that's what I had mentioned in prior classes. So in short, we're always going to hit the income statement and balance sheet for adjusting entries, and we're never going to use cash. So number 3, on October 1st, Pastina borrowed $50,000 from a local bank and signed a note. The note requires interest paid annually on September 30th at 12%. The principal is due in 10 years. So right now, there's some information here that it's actually not going to, so right now it doesn't matter right now that it's due in 10 years. What we have to do here at the end of the year, the fiscal end is in December 31st, so it's a calendar year, and we have to accrue interest. So 3 months have expired since the note, right? So we have October, November, and December. We need to account for interest expense during this time period. So what we're going to do is we're going to have a debit for interest expense, income statement, and a credit to interest payable, balance sheet. And that's going to be $1,500. How did I get that? I took $50,000 times 12% times 3 divided by 12. Why 3? Because since October 1st, we have to include October, November, December are the periods that we're accruing for. Number 4, March 1st, 2016, the company lent the supplier $20,000. Note was signed requiring P&I, principal and interest at 8% to be paid on February 28th, 2017. So think in your head, we are getting a note, right? So they are signing a note from the supplier. So it's an IOU. It could be very well that, they didn't do so well with their accounts receivable. It was aged. Usually if that happens, we can go ahead and get some kind of financial instrument created by note. And that's more, it's better for legal enforcement. So what's owed to us is interest revenue. We have to accrue for that. And we're going to credit interest receivable, we're going to debit, and we're going to credit interest revenue. So 10 months have passed that we get interest revenue for. So we have to accrue for this from that starting point to the end of the year. And that starting point was, that whole period was 10 months. So we're going to take 20,000 times 8% times 10 divided by 12, and we will get 1333. Again, that's a debit to interest receivable and a credit to interest revenue. Number 5, April 1st, the company paid an insurance company $6,000 for a 2-year policy. The entire $6,000 was debited to interest expense. So what does that mean? So the entry can be confusing due to the passage of time. So originally it was incorrect. We understated net income, right? Because we took that whole amount and we debited insurance expense, credited cash. So everything went to the income statement. GAAP allows us to have to account for prepaid items, and just like rent, insurance is passage of time. We were going to allocate that cost. So we're going to debit prepaid insurance, and we're going to credit insurance expense for the remainder. And so let's see how many months went by. So we can do this a couple of ways. So let me see. So prepaid insurance, we had $6,000. We take 15 months that have not expired, divide that by 24, and we get $3,750. And the textbook shows or illustrates maybe a different way of doing this, or gives alternatives. So basically we have to account for what has not expired yet and make that the prepaid on the balance sheet. So the credit is actually giving us a better net income as compared to the original $6,000 that we put on, that we charged the last period. So that actually helps the income statement. It helps net income, and it helps the balance sheet. So it increases net worth. $800 of supplies remained on hand. So the difference here is, okay, what do we have supplies over here? We have 1,500, and now we have 800. So the difference between that is 700, right? 1,500 minus 800. So that difference, that $700, we have to account for through expense. So we debit supplies expense and credit supplies. Number 7, a customer paid Pastina $2,000 in December for 1,500 pounds of spaghetti. It's a lot of spaghetti. To be delivered, keyword, in January. Pastina credits sales revenue. So think about that. And I said it a little bit earlier. When you receive cash, you're typically in a typical transaction, you sell something at the register. Here's the stuff, give me the cash. Or here's the service I performed, pay me. So they're actually receiving money, but they haven't done anything yet. So they incorrectly report this as revenue. So we have to change this to a liability called deferred revenue, because we still have an obligation to perform. So if we receive deposits, cash for something we didn't do yet, we have to account for that, not on the income statement, but we have to account for that as deferred revenue. So the entry that we'd have to do is we have to reduce sales revenue, a debit by $2,000, and credit a liability, deferred revenue $2,000. Originally, this should have been recorded as a debit to cash and a credit to deferred revenue. Same net effect. So number 8, lastly, on December 1st, $2,000 rent was paid to the owner of the building. The payment represented rent for December 2016 and January 2017, basically 2 months at $1,000 per month. So we received $2,000. Oh, I'm sorry, $2,000 rent was paid by the company, right? So we have to account for this. Let me just double check this again. On December 1st, okay, so on December 1st, that still have a month left in the year, right? $2,000 rent was paid to the owner of the building. So we're saying, okay, we're going to, on December 1st, we're going to pay you for this coming up this month, December, and January, right? So that cash, the January at this point in time, that time has not elapsed. So it's not rent expense cash. We basically have some prepaid rent here. We have prepaid rent for January because that January time period has not evolved yet. So on the balance sheet, we're going to have prepaid rent of $1,000. So the debit is rent expense for $1,000, and the credit is prepaid rent for $1,000. Actually, originally, it looks like this was originally booked as prepaid rent from what I'm seeing now. So prepaid rent was originally booked at $2,000. But we have to reduce it by $1,000. So on December 1st, 2016, $2,000 rent was paid to the owner of the building. The payment represented rent for December 2016 and January 2017 at $1,000 per month. Let me get some thinking on this, because actually I think I'm confusing myself. The point here is that when we pay cash for an expense, keep in mind the time periods that the problem is talking about, because most likely you're going to pay for something that you didn't receive. So you may have not received the benefit of rent or any other asset, and you're allowed to make that asset an asset. You're allowed to bring that on the balance sheet as an asset rather than expensing it on the income statement. So I'm actually this is going to be obviously posted in class. Any questions about any of these 8 journal entries, please post underneath, and glad to have you guys here, and please let me know if you have any questions. Thanks.